Hello, everybody. I'm Bonnie Helper. I write the weekly Startup One Step newsletter, which goes out every Tuesday morning. I'll put the link in the chat. And I help founders with their pitch decks and executive summaries and talking points when they're going to meet with investors because they don't know how to do them properly, right, Rich? And I also help with their ghostwriting. I'll put all my information in the chat. And I want to thank Joseph Katz for hosting us. Joseph, tell us about you and what you do.
Thank you, Bonnie. Great to be here. Thanks, everyone. My name is Joseph Katz. I'm a startup marketing guy. I help companies go from unknown to well-known, putting in place go-to-market strategies and customer acquisition plans and helping them grow. So great to be here. Everyone can throw things in the chat as the conversation evolves.
And I'm so happy that Rich Gupta is with us this time around because it's very hard to get family offices to talk about what they do and how they invest and they're very different from VCs and angels and any other investment vehicle. So thank you so much, Rich. Do you want to should we have Sam quickly introduce himself because we know he has to leave or and he'll be back or
Sure.
Sam?
Oh, this is me? Or
Yes.
oh, okay, I'm Sam, CEO of Axel AI, traveling around, just came from a big trade show, and my company does AI software for video.
Oh, thank you.
Awesome.
So, Rich, do you want us to go around the room? I know more people will show up, or do you want to talk about yourself and your background? And
Sure. My name is Rich Gupta. After leaving, I guess, Wall Street for about 20 plus years of work, we decided that three partners and myself decided we want to create wealth and legacy for ourselves. That was back in 2004, 2005 timeframe. Started as a little guy in a Wall Street when you go to work and everybody tells you, go get me coffee or something else of that nature in those days. But it was a great journey, a lot of learning, a lot of experience, a lot of interaction with clients. And we got picked up by a West Coast firm. And I call myself, I'm stuck in SoCal, but my heart is still in New York City. I love New York City. But I travel enough, so my travels do take me to New York City often. It's a great journey, learning from Wall Street, and currently I'm based outside LA, and I'm part of a multifamily office of 7, and we are all ex either buy side or sell side. A buy side being Wall Street firm, or a sell side being Wall Street firms, or a buy side being the family offices or other asset managers or hedge funds. And we mostly operate or invest capital in fintech, health tech, and my term, which is new tech. And that includes pretty much cryptos, blockchain, AI, Web3, and anything going on in space. And we just go through. I usually don't use any slides or pitch decks. I like the interactivity. I can speak just without questions for hours, but I'm also teaching a fintech course. It's called Fintech, Blockchain, and Crypto Assets in a small college right behind in our area. And it's a great experience to share knowledge and learn from others. And I mean, I heard from you, Bonnie, that this will be very open, communicative.
yes.
So if you got questions, feed them up, or I can just keep going.
Oh yeah.
I
We
know
have
you.
we have everybody introduce themselves, and then we open it for Q&A. And I know you can keep going. I'm always happy to hear anything you have to say, Rich. So, Carol,
That's for sure.
Carol, tell us about you.
Yeah, I'm a data scientist up in Toronto, so I dabble in data science advisory for startups, AI product integration, predictive modeling for operations, and data analytics for corporate remediations.
Ah, thank you. Patrick, I don't know who iPhone is. Patrick, you want to introduce yourself?
Hi, sorry for being a little late.
No, no worries.
Patrick Fraley, based in New York City, a lower middle market investment banker. So primarily we focus on sell side M&A. and love working with founder-backed businesses. Look forward to saying hi to everyone.
And welcome. I don't know who iPhone is, but you want to introduce yourself, iPhone? I guess not. But anyway, I'm sure more people will come in. So any questions or?
No, I
Oh,
think this is a small and good size group. So I think the best you can get out of it is by open communication and
Yes.
Q&A.
So
It's your show. You tell me what you want to do.
Bonnie, can I kick it off with a basics question?
Absolutely.
Rich, maybe you can, for those listening, maybe you can just define family office and how
Yeah.
it differs from the other investment setups.
I was going to ask that myself.
That's an excellent question. Let
Yes.
me back up a second and talk about the genesis of family office, asset management, hedge funds, and the sell side of businesses and how, and then you have massive corporations and investors from pension funds to sovereign funds to all category. I mean, you have a major investors also called insurance companies, and we can drill down each one of the categories. But the question was about the family offices. So what happens is most of the investors, when they are capable investor themselves, they really don't need much advisory, but they need access. So we need access to product. What is the access means is to the product, not for any favor, but more category of solutions and the product there are, better we are. But we are such a niche player. We mostly focus on fintech and healthtech, and then new tech coming on. And then other side of that, personally, I'm also big time involved with a couple of family members and other teams on real estate. We do a tons of work on real estate for commercial real estate, and we lend against it. And we're also building a hard money / bridge money lending platform using blockchain and AI. So family office is mostly could be single family office, could be multifamily office. Single family office usually is the net worth probably, or the asset under management is between 50 to $100 million assets, and they are looking for same thing, product and resources for their own families or providing solutions to family members and whatever, right? Then we are part of something called multifamily office, and that also is combination thereof. So multifamily office is a bunch of common people who know each other. We know each other for more than, I would say, the longest person we know each other is for about 3 decades. We all started in very, very early stages of Wall Street plus buy side. And then we went to create our own, and some are still very active and building their own resources. And some have just taken a siesta and they're on the beach somewhere, just like Carol's background. And it's just amazing. And then our multifamily office also, there is a combination of multi offices where a manager will come in and they will have other family members join them as an open platform. Ours is not open. We are only 7 members, and we invest our own capital. We don't raise capital from anyone. It's mostly, if you have used the word or have probably heard the word called syndication, it is that kind of multifamily structure we have, very open. And one change we did was to become a unanimous consent. What does that mean? So we have analysts who review most of the deals before we get involved. So I'm mostly the face of the family office, and we talk to folks. And there's another partner of ours who also is engaged. And basically, deal get pitched, and then we just don't have enough time to review the deals or go through the transactions or talk to the company owners or the I mean, the earliest example I can show you is funding to a startups or venture funds. So if you look at a venture side of it, usually you funding on a jockey, right? And you know where the player's gonna be, where the transaction is gonna go. But mostly on the startup scene, you're funding who the entrepreneur is starting up, what is their background, what have they done, what is the product, how is the market game plan, where they're going to want to be, where are they in 3 to 5 years, what their projections are. All that you can look on one meeting, second meeting, you basically grill them down on the team. Third meeting, you decide whether you're going to invest money or not. But when we get involved, we are mostly on a growth stage company investor. So we bring in the details to our analysts who are basically going through and stratifying deals and looking at based on our risk profile, whether this is a good investment or not. And then one of the main criteria we look to invest in is what is the market participation for that product, that service, or whatever company is trying to do. How much revenue is out there, what is their game plan, and what the team looks like. So that's the multi-office structure. And if you go back to the investor side, you have all kind of investor. You personally could be investing your own money, whatever capacity you have. You're also an investor. But major investors are mostly in the pension fund environment. You got insurance companies, and you have asset managers who are accumulating wealth from either accredited investors or corporations and whatnot. And they then invest on behalf of their participants. I went long ways, but I hope I answered your question.
So I want to say something. Family offices are often called patient money, as opposed to, of course, VCs who want a return or an exit as soon as possible. So do you want to talk about that?
Patient money or quick money, that's the word you probably will hear more and more. Every money is patient money to start with. Everybody, when they invest, they're looking for decent return.
Right.
No investor we know who says, hey, I'm investing to lose money, right? So that's the background. So patient money means that we invest capital for a longer term. We don't have a risk profile in our asset management style where we have investors who we are working for and who have provided us capital to give
Right.
return every 3 months, every 6 months, every year. So they will have quick return, quick exit. So most of the venture funds who are solid and decent size, they are pretty long-term investor. I mean, they are looking at a venture side or Series A, B, and C size. Most of the investors are looking for at least 3 to 5 year investor horizon. And some do follow on, some don't do follow on. And yeah, I mean, the term sticky money versus patient money or fast money is used to describe the investment criteria and how the investor is investing their capital.
So, question: what size are your usual checks, and do you follow on funding as well?
We have so usually our minimum is about 2.5 to 3 million, and we have gone as high as 25 million as a follow on and everything. Because the reason of follow on is that, say you started with 2% or 5% of the company as your investment, we never take major stake in the company. We don't take 50%, 51%. We are not operator. We have zero interest to operate in the company. Advisor, maybe board membership, maybe, but not as an operator. We have zero interest to acquire the company and operate. Whenever we invest, we are investing money for the growth of the company. And at this stage, we are looking at their product or service, how the market has accepted that product.
Oh, thank you.
And will you all co-invest on an acquisition? Like a
Could you
sponsor,
repeat that
private
question, please?
If a sponsor is going to, private equity is going to acquire a business, will you sometimes co-invest? alongside things.
That's the exit strategy, right? So if some other investors are coming in, private equity mostly takes, if they come in, they may take a minority stake, or most of the private equities will want to take a majority stake because obviously they want to do something else with it. But there are some smaller private equity shops who may take a minority stake. And if they want to stay along with us, great. If they are acquiring the company, now that's a question whether we utilize, and sometimes we have tag along, means we will be participant and see how the private equity wants to operate the company or assemble and disassemble. I mean, majority of the private equity investments are mostly assembling and some disassembling. So we don't participate when they are disassembling the companies. We try to exit out faster.
I have a lot of clients that are interested in having family offices be investors, particularly those that are kind of sustainably minded, ESG focused. And I think the big thing that me and folks like me that are trying to find those kinds of investors is that it's difficult to find family offices because they don't always, advertise
No, they
to
don't.
contact them. How would you kind of recommend? I know that there has been a little bit of a push, particularly with some of the larger offices, to make themselves a little bit more accessible. But I'd love to hear how you all have done that, or how you've seen others do that.
There is no secret sauce. It's just grunt work. There is no, I don't know anybody who has emails for all the family offices, but some people claim they have. You won't find us anywhere. You will find me personally. If you search Rich Gupta, you will find me somewhere. But that may not be a reflection of our family or multifamily office, but that'll be a reflection of myself, right? So you have to find, if you go back to the basic of marketing and sales, right? So you have to find something common. What is the common you can find to an individual and reach out to that, and then see if they are interested in introducing you to a multifamily office with the product or resources. I mean, we get hit with service providers, all kind, not just the product side of it, all kinds of service providers. Oh, we can manage your operation. Okay, God bless you. We don't have much operation. We have 3 analysts. You want to manage it? Great. God bless you. Come on in. And then, we want to provide you services for insurance and taxes. We already have people with us for 20, 30 years. So it's harder to penetrate. But if you stay consistent, probably you will pick up something in between. And I don't want to demonize that, but it is difficult to meet. I mean, it's similar to if you reach out to a private company, it's harder to interact with the CEOs or COOs, but you can always find somebody who you can link up and maybe they can introduce you. I mean, I like to share one phrase I use is, sometimes it's very hard to get to the king, but it's very easy to get to the people underneath the king. Everybody wants to reach to the king. Okay, God bless you. You may never get to see the king, but how about you interact with the people on the kingdom and find somebody in between who can get you to the place? And that's the basic of marketing and sales. I've never done it, but I've learned enough. I'm surrounded myself with the best of the best in the industry who have done marketing and sales, and they're very, very savvy. And it's just grunt work. It's consistent.
And are you all kind of acting as a fund of funds too, investing in other funds?
That was my next question.
That's I mean, we have a lot of fund managers as a very close friends, and they always want us to invest with them. There's only 2 funds to date we have invested as a fund. We are a cap stack investor. We like to be on the cap stack, and we like to follow the growth of the company, and we like to be sometime on the call directly when the managers are making the calls. I mean, in our group, I think most of the companies, not only they do quarterly, they're also doing monthly updates. They're doing monthly video calls, especially nowadays with the Zoom calls or Teams or anything. It's so easier to communicate Not to say that if you're a fund manager, you can't have access, but it's our personal preference. Our preference is to be a cap table, and we manage money. I mean, we all ourselves is very stickler about expenses, and we have managed money. I mean, we have done, all of us, all 7 of us have done tremendous amount of wealth creation. And now, yeah, we are a multifamily, but we are respectful, but we invested only 2 places as a fund managers. And we've been at it since 2012. So that tells you what we're doing. We don't brag. We don't list our companies. We don't tell people what we do. Our friends, we will obviously share information with. People always want to know, hey, what's your AUM? Okay, God bless you. We ain't telling you. But our friends know. I mean, we are interacting, and some friends know what we have invested in. We will share the information because that's what the knowledge is.
When you're saying your friends, are you going to, I know about these kind of family office conferences
Yeah.
where a lot of family offices come together. Is that where you're primarily going to, get the
I
word
try not
out
to.
for what you're looking for?
No, I try not to. I mean, friends is the people we know each other for decades or 4 years or 10 years. We tried trying transaction together. Those kind of friends, not meeting people at the I get invited to more than once. I try not to go to those family office gatherings. Mostly, there are some very good people there who are looking for some more investments or criteria thereof. We are not. I mean, we get hit with so many deals flows and transaction thereof. We don't have to market ours. We are not raising capital. People in the industry know us. They know our focus. And our real estate business, that's a different side of the business we are in. There, I may go attend a session or 2 in some specific family office and then come out.
So, speaking of real estate, what do you look at in real estate? Is it prop tech? Is it real estate itself? Is it?
No, it's a real estate, hard asset.
Oh, okay.
Hard asset, mostly anywhere we can make money on. So money drives us. So we are not a buyer and hold it for 30 years or 20 years. Our goal is to either broker a trade or buy a property. We are not looking at single family. We are looking at mostly used to be office buildings, which we traded a couple of them. But office right now is going through such a cyclical
Yes.
cycle, is a disaster. But I call it office market as a tale of 2 cities, especially in a major metropolitan or major cities in Western world. And it's probably maybe Sam can share me some information on what he's seeing in Amsterdam as he's traveling. What we're seeing here in the United States is pretty much tale of 2 cities. You have a major money center cities, mostly on the coast or all across the country. Occupancy rates are like 50 to 60%. You can't meet your numbers on that. Then you got second hit, which is interest rates. I mean, yeah, Federal Reserve dropped the rate yesterday, but it's a peanuts compared to where the
Yeah.
markets are. You got 2 major elements on real estate, occupancy, and then if your occupancy is low, obviously your debt coverage is not there. So you have a new category, new underwriting criteria. So instead of underwriting at 80%, 90% occupancy, so that equation went down, and now the rates are still higher. I mean, just in 21, and if you go back to even 20, just 4 years ago, rates were handle of 1 and 2.
Yeah.
I mean, 10-year was trading at 1 something, right? So, and the commercial CMBS market was trading right around that, 1.2, 1.3, 1.5. And now the same rate is, okay, 5%. How do your occupancy is down, so your revenue is down, and then your cost of carry the mortgage is higher. How do you make sense out of it? Sam, what are you seeing in Amsterdam? I don't know how long you've been there. I don't want to put you on the spot, but it's
No,
a
no,
free knowledge,
yeah,
man.
yeah, absolutely. Amsterdam looks pretty healthy, actually. It's, I'm not seeing a lot of empty retail spaces or empty office spaces, but of course, in Amsterdam, a lot of the office spaces are in the suburbs, so
Mhm.
I couldn't really gauge that. But overall, it feels very vital here. I was in Brussels yesterday, and by contrast, Brussels, there's entire buildings that are empty, which is surprising because it's the capital of Europe, of course. But Brussels is a very you know messed up city. They have it's a patchwork of, I guess, 18 different districts. So each of them is run like a mini city, and some are well kept, and some of them are, there's crack addicts on the street.
Yeah, I know.
And there also, there's a lot of migrant neighborhoods, Arabic neighborhoods that actually seem to be doing very well, but they tend to be a little bit more down market and it's like west and east. The west side is the Arab side, east side is the European side, and they, it's almost like an apartheid, like they don't go to each other's neighborhoods. So it's I wouldn't say Brussels feels like a very healthy place, um, but there's an opportunity there. I don't know if there might be some very affordable deals either on commercial or on multifamily residential there, but it certainly feels well occupied. Everything, all the residential stuff seems full, but the business is sagging, and it's overregulated, and all the reasons that the right wing in the UK wanted to do
Don't talk to me
Brexit.
about overregulation. We are dying with it. So,
I know. Well,
but
you think it's bad? Just move to Brussels, right?
yeah, I
Brussels.
know. I have a lot of friends. I was in Brussels last year on a one-on-one meeting with the family office who flew in from Germany,
Mm.
and it was amazing tour of the city,
Oh, so you've
especially
seen the
the
place? Yeah,
palace, and then the food and delicacies are beautiful. But
yeah,
but in real estate side, the second city we see in US is suburban, which you mentioned, Sam.
yeah,
Suburban, where we even live, of major city outside LA, it's you can barely find a space. So
yep,
that's the tale of two
yep,
cities going on in Western world. And I was in London also earlier this year. It's just drastic where properties are and globally and in US. I mean, it's a drastic change, including the 50 basis points, which is a it's a headwind approach as to what is this 50 basis points? Is the economy really in the tank? We're not seeing it, which they are seeing it, or is it a few weeks before election? We don't know.
yeah. Well,
Bonnie, you
people were
got more
shouting.
questions?
People were
Yes.
shouting at them for so long. I guess when they finally reacted, they felt they had to do extra. So
Well, okay.
we'll see what happens.
I don't talk politics on this call, so I'm going to stay
No.
away from that.
Yeah, we try to do that. Yes. So you're heading down to Latin America. So are you shifting an investment focus down there as well? I know you're meeting with family offices, but just out of curiosity.
It's a twofold approach. One
Yeah.
is to share knowledge and gather knowledge, and then also evaluate what are the options are open for us to directly, and because our multifamily, we usually don't invest through other families or other funds, but we don't have any experience. But their real estate and their fintech and healthtech is growing leaps and bounds. So we
Yes.
need to evaluate that. And we had few conversation already. They said, not, I'm just walking in blind. And we will see. Those are the two approaches.
Okay. Any other parts of the world that's coming under your radar in particular, or
Part of what,
Asia,
Europe?
Asia, Africa? A lot of talk about Africa as
Africa is a great value proposition, but then you have a lot of geopolitical risk, which guys like us, why? I mean, the question comes to mind, why? Can we not get a similar return here? I mean, yes, we are looking at ESG side of it. Yes, we're looking at humanitarian side of it. Yes, we invest donations on charities, but that is not our core focus. We are actively looking at India, which is another major horizon coming down the pike.
Yep.
There's a lot of growth on their side of it, on fintech and health tech, and especially on the new tech side. And we're paying attention to that. There's a trip supposed to be planned sometime December, but I have not committed yet. But we will see.
I know 42 Geeks are about to do their trip to, they're going to India, right? Yeah, that's their next stop.
India is a big, big horizon. It's a big country, a lot of inner politics we have to deal with. But geopolitical risk is limited. I mean, they are a democracy and they have a rule of laws and whatnot you can think of. But, as an investor, we may end up taking a position within a fund there. That's the one approach we are looking at eventually. And then just look to expand on that fund. And because you need, in that kind of area, you need feet on the ground and to see, and the logistics people who can sort through all I mean, yes, I'm born and brought up in India, but I left India a long, long time ago. And I have no experience than any other investor, other than maybe I speak some part of the languages, because India is also so broad.
Yes.
They have so many languages, local languages, but English is the main thing. And I have yet to interact with any part of India where I said, "Oh, I don't know how to speak this," but everybody speaks English.
So, question: do you ever look at accelerator programs, investing, which have?
We did. That was a long time ago when we learned our own lesson. We pivoted from investing into early stage. I mean, we didn't know. I mean, we were all ex-Wall Street guys and a gal. And what the heck we know about startups? As I said earlier, startups are you're betting on a jockey, and you're hoping they have the horse and they have a structure behind it and they will do something. But we learned the lesson that we were horrible, and money doesn't solve all the problem.
Right.
And we were just throwing money at it, and we brought analysts to review, but it's just too much hand holding. We just don't have, and especially me, I'm involved in so many things. I just don't have enough bandwidth to broaden and stay. And we looked at a couple of accelerators to support and to see, but we didn't get too far away on that transaction. We are looking at one local in Santa Monica, which is a very decently known, and maybe we take something with them. We haven't decided yet.
Is that Expert Dojo?
You got it.
Yeah, so they're actually on our advisory board, and they're good guys. Brian's a very solid guy there, and they have a nice portfolio actually.
Brian McMahon is a very good friend of mine.
Oh, is he though? That's excellent. Okay, cool. Well, I guess he's in Singapore right now, right? He was just flying over for.
Yes, they went to that Singapore something going on. I was invited. It's too many trips.
Oh, Singapore is.
You
I've been to
can
Singapore.
literally travel the globe every day.
The last two
And
times I was in Singapore, I went around the world and came through Dubai, and it's like, oh my gosh.
it's just we get invited or asked to present and teach and speak, and it's like, God bless you. Bring it to US. Maybe we will see if we can attend.
Sure.
And we do. I mean, we don't personally. I restrict to maybe 3 or 4 trips to these conferences. And as I said earlier, my real estate side of it, maybe I'll go attend in 1 or 2 more. But on fintech and health tech or family offices conversation, try not to attend too many of these. It's just too much.
Yeah.
So, does anybody else have a question? We don't mean to sit here and monopolize. Carol, anybody?
I had a question, Rich. So in terms of, who your investors are you taking on more families, or are you kind of set where you are, or talk to me a little bit about that. I'm curious how you raise or.
We
Where
are
you are.
not. We are not taking any more money. We're not inviting anybody else. We may lose one member by end of maybe next year or this year. They're deciding what to do and how road where to go to, and they want to focus more on their charity work and philanthropy, and maybe we will lose them. Our goal is to shrink it down, not to expand.
And
Um,
oh, sorry, go ahead, Carol.
Yeah, I was just gonna jump in with a comment as Rich, you were working with the startups. Part of the main part of my data science advisory for investors in regards to the startups is like they all talk a good game, they sound stuff. I wind up finding the ones where the majority tell the investors, no, you got to walk away from this. This is not going to go in any way, shape, or form. There are too many things there. So that's why, you know, people get in, you don't know really what the problem is. And there's some things within the data science realm where, you know, your problem, things are inherently biased. You can't throw more money, more data at this. It's just, that's not going to work. And, you know, being able to at the get-go say, okay, this is potentially viable, yay, go, or if it's definitely not viable, don't do. And it's like what I've seen, 90% it's things you need to walk away from in that realm.
I mean, look, if I can add to that, is startups are, I love entrepreneurship and I encourage that, right? So having said that, you also have to pay attention where you're putting your dollars to and where you're putting your money, your personal money, and then it becomes real. And if you're investing even a small 5%, 6% of your money, it's still a lot of money, which is your own money. It is not some money coming from pension fund and whatever. And then it all becomes real to you when you go to the next meeting. And when you go to the next meeting, and when you go to the next meeting, you go three meetings and you don't even see the product. Now you got to decide, did I sink in my money in a wrong place? I need to walk away. Are they looking for only money at this point? Are they have surrounded themselves with the good product details? Have they even gotten to a product development stage? I mean, we funded the folks we funded 27 of them in very, very early stage. Some were just the pitch decks. No MVPs, none of that. And most of the time, there's a different style of startup investing, and you as an investor have to focus on where is your risk parameter. And we got into the traps of liking the individuals, and we were ignoring our own common sense and looking at the approach more objectively. That's a drawback in our investing. And the knowledge we came out of, I mean, all of us are very, I mean, we all came from massive corporations. We had all the support system with us. We had risk managers, we had analysts, we had operations folks people, and this could be only one person. How do you know they're accounting all the things right? How do you know their product development time is spent right? How do you know their product itself is getting viable or not? How do you know their services they are trying to promote? If they talk to any other provider and see how that product is working. And every entrepreneur has an amazing story, amazing strategy. And the question is, when do they lose their job? If they are still doing their job, which we didn't mind, we didn't ask everyone to lose your job first because it may not be the prudent thing. So they are doing their job on the side and they're putting some time on this product, what they are developing, but they got other people who have already been their partners for longest of time and they're developing the product or services together. So you have to really, there is no right or wrong answer. I mean, I've seen all kind of investment criteria where people just tag along, means everybody jumps on, somebody says, hey, I'm putting my 1,000, okay, you put 1,000, you put 5,000, whatever the number is. And those 1,000 could be million, or those 1,000 could be dollars, or whatever you're talking about. But always pay attention to, in your gut, is this the right product or service you want to support? And then who's the player behind it?
I know you don't usually take board seats. Do you ever come on as advisors?
No, we have taken a board seat.
Oh.
We try not to. We're not looking for it. So most of the early investors are looking for board seats. And we will only take a board seat where we see the value add, where we are really adding value to the operation, to the management, to the team, strategy thinking. It's a level of investment and level of time you have to invest on the board seat level, but you can do without it. And then the last thing you need to pay attention as a board member is the company itself doing everything right? As a board member, you could be held liable for other investors' activities. So you have to worry about the liability. It's easier said than done, but board of advisorship is also, it's risk prone, time prone, and you have to value that and figure out where your time is spent on.
Alex got here late. You want to introduce yourself, Alex? And if you have any questions, feel free to ask.
Sure. Sorry, been one of those mornings. I'm Alex Luca. I'm by background I'm an investment banker, but more recently have pivoted into private equity with a focus on specialty lending. So think about factoring, asset-based lending, effectively the provision of working capital finance to small, medium-sized companies in the UK and in the US, a little bit in Latin America as well. And this year have pivoted one more step into my first startup, which is a fintech. I've shared a deck with Bonnie in terms of, it's a little while ago, but it's a fintech SaaS model. It effectively sells enterprise software to factoring companies and the like, and there's an embedded finance angle in it as well. But happy to discuss that offline with anyone that has any interest. And funny enough, Rich, this is very topical because we are currently raising a seed or a round. And funny enough, we are looking for someone that has industry expertise, has done this before, and can not just provide capital, but more importantly, provide advice and serve on a board level. Although I completely understand your point in terms of
risk.
Do you need to actually serve on a board, or can you just be the that rabbi in the room, so to speak?
We like the second part. We like the rabbi or a consigliere on the side.
Exactly.
We don't want any liability. It's, in America, everybody can sue everybody. I'm based outside California. So, and you have no clue how much money gets spent defending yourself. Anybody can sue you, but go defend that.
Yeah.
And so we are very practical in that sense. If it makes sense, and if the company has a D&O, then maybe let's look at it. But we don't even want to be on board of advisors seat. But if we can help the company, if we have invested money with them, and maybe as an advisor, every investor, when we invest in the company, we make sure the companies know that we are available. It's up to them to reach out to us and let us know. Other than that, we just take a back seat. We are a very minority investor. We don't want permanent seat. We don't want majority stake. I don't think we never got into more than maybe 10-15% cap stack. That's it, if that much. And we are coming at Series A, B, and C now. So it's much later stage, bigger cap stack, and we try to just avoid any conflict and at every cost. It's the easiest thing you could do, but it's very hard because everybody wants you to be in their deck, in their name. They all want to promote you. I don't need promotion. And I have to watch out my liability. And liability costs a lot of money. And if most of these companies, they may not even have a D&O policy. And if you don't have a D&O, you're not doing a justice to your board of directors. Especially if you're taking investors' money, especially if you're taking retail investor money or accredited investor money. And that becomes a big, big red eye for us. Big, big red flag.
Oh.
We don't want that.
Absolutely. You have your own reputational and other risks to manage at that point in terms of.
Yeah, I mean,
external
if you
money.
remember, the old man from Omaha, Warren Buffett, always said that your reputation is what you have, and it takes less than 30 seconds to destroy it.
Takes a lifetime to build, but less than
Yeah.
30 seconds to lose.
Otherwise, you got nothing. And guys like me, especially myself, I pay real attention to that. Our words mean a lot. Our access means a lot. And if we can help someone, we go out of our way to help. That's not an issue.
And out of curiosity, I apologize if you've already covered this, but what is your strategy generally in terms of you come in at, let's say, the A or B round, et cetera? Do you look to exit 1 or 2 rounds later in a secondary, or are you generally in for the lifetime of?
I mean, if you look at the market, our goal is to make money, right? So we're not, yes, we are patient money, but we are looking to turn our money and make some money. And we have done, I think, 2 investment I mentioned earlier at through the funds, and those will be more legacy investment. I don't think I will personally take out my share, and it's one of those things you just leave it for next generations or whoever's coming behind you to manage that and take care of it. We are investing to tag along, but the market as a whole hasn't seen much exits. If you look at equity market and the IPO market, especially you coming out of PE side of it, you won't see too many exits. And if there are exits, they've been very not properly priced. It's priced to the demand and supply at that time. So it by default has become more carry on. I mean, you are basically carrying and adding or not adding, and that's the approach.
I mean, there's been a couple of like Revolut, for example, which is a completely different size, but they just did it was 100% secondary, where they allowed some people to come in on the institutional side, but it was effectively all employee stock, so there was no actual capital raised in their last round. But that's, I think, few and
I
far.
mean, secondary trading is because of that. I mean, there is no exit. So, and most of the companies are trying to do also is they will offer a tender offer where the employees can certain percent of their vested shares can take out at agreed upon price of the tender. But there's a big secondary market. We also participate from time to time, either for our own self or we just broker it out. And there's a pretty big active market now. We had never seen that before, but since the equity markets have really dried out, IPO market is pretty much liquidity driven, and there's rarely seeing much.
Yeah.
I mean, our hope is this 50 basis points will trigger some changes. Time will tell. But our hope is also that, I mean, we are very market driven and product driven and service driven, and we keep an eye on the market, but we are hoping that we're not missing the whole, whatever the Fed is seeing. Maybe they are seeing much worse condition coming down the pike than we are seeing it, or Federal Reserve just reacted to the market pressure, or elections are maybe 3-4 weeks away with the early voting. So we don't know. We will, I mean, there must be something which they made them do this exact mood. There are participants who say they could have started back in July, or they could have started back in April or March. All right. All kind of participants speak, and you have to pay attention to them. Our review is that this 50 basis point really sends the market a signal What will be, we don't know. We will find out in next week or two. It takes time for market to digest and all the analysis to go through. And then the real impact is 50 basis points impact would be in the market between maybe 7, 8, 10 months from now. So it's a big, big move. We'll see.
Earlier, we were talking about empty office spaces, and just this week, Andy Jessup over at Amazon announced that all employees have to come back to work full time as of January 2nd, 2025. Do you think that that'll have repercussions with other companies and industries? And
You know, I have never predicted where the Fed will go. We are a market participant, so we look at the market as a whole and position ourselves. We are also longer term investor. We are not looking for short term pickups and whatnot. I mean, there's people always talk about Fed put and Fed call. I mean, if you look at even the market, right? So your Dow is at the highest level, S&P is the highest level. You got NASDAQ at the highest level. You got real estate, which is pricing as crazy as possibly you can think of, other than distressed real estate. You got secondaries, which are pricing at pretty decent pricing. So as a prudent investor, do you keep dabbling into it, which we don't have to, right? But if you're a fund manager, what do? It's a challenging time for fund managers who are managing multi-billion-dollar platforms and resources thereof. You damn you do, you damn you don't do. And that's how we see in the marketplace, where people are adding on or subtracting and waiting to see what the reaction would be. I mean, if you look at the whole 7 top tech companies, right? Where do you think the growth is? I mean, AI is still blowing up, right?
Yeah.
So if you want to invest all kind of AI, all right, God bless you. How much you're going to see, what's going to happen? Which AI part of you want to go into? You want to go into the hardware or the software side of it? And then you look at the other tech firms from Google to Meta, to Amazon. And where's the growth for Amazon? You know, I mean, their AWS is doing an amazing job. Can the AWS be the main backbone provider for AI? Time will tell. Where do you go? I mean, where do you invest capital on? So I don't differ with people saying, hey, let's wait out till the elections are over. But I also know people who are investing capital.
And have you yourself looked at AI and deployed? I mean, I'm sure you've looked at it. Have you actually deployed capital?
We have rejected about 25 companies, 23 companies. We are still looking at 2 because everybody wants to throw AI wrap on their product.
right.
We are an AI company. God bless you. Show us how. Show us what is their main criteria behind it. If you're using AI as a calibrating agent, you're not an AI company. You're wrapping it up. What is your underlying platform? What does the platform do? And how is AI benefiting your company, not only this year, next year, and 2 years, how's the 5 years from today? What other platforms are coming on the pipeline which you are looking at or not looking at? So it goes down to the basic business model. We have invested my own personal capital as well into certain AI companies, but I wasn't going to share that. And but as a company's investment, we have rejected 23, and we are looking at 2 more.
And what series are you seeing? Series A, C, pre-seed? Where are these companies that are coming to you?
Most of the companies come to us, either they are late seed, or they think they are A, but their revenues don't support to be A. We believe they are still at the seed plus. Revenue levels got to be much more higher for us to participate in than where they are.
what's their timeline to either profitability or exit, or what do those milestones look like in the AI
We are
world?
looking at mostly companies who have revenue. I wouldn't say we don't want them to be profitable. If we take into A company or B companies, they may not be profitable, especially in fintech and health tech. And especially if you're looking at AI driven or even in the blockchain environment, they may not be profitable till they get to a little bit more activity in the marketplace. So yeah, we want all companies to be profitable, but that's not the driver for us. We are looking at their growth trajectory more so and their participation in the marketplace.
Are you looking for businesses that kind of in the startup world that have like a venture type of return? I always hear, a really large addressable market, and it can give you 100 times your investment or something very large, very high IRR. Is that what you're thinking of? Or
That will be
you have a different
always,
perspective
that
on
will be
things.
optimal, but we haven't seen one yet.
Okay.
Everybody wants to come to the market. Oh, we can generate 50x or 30x or 40x in 3 years. God bless you. Show us how you're going to get there. Talk is cheap. And projections are cheap too. Anybody, and then you strat out their projections and then you see the holes. What if scenario is so simple to do, but majority of the entrepreneurs fail to do it? Or they will look at their competition and they will have a chart on the competition as well, but they're not really drilling down all the activities what the competition is working on or projected to win or projected to work on, which they have disclosed. So you have to really drill down when you're investing capital.
Is there anything that would make you have a quick no, like for example, the addressable market isn't over $1 billion, or I'm just curious, considering your long-term horizon, you have a different way of thinking about things.
Most of the investments we look to do, or investors will look to do, is Series A and B. We are looking at what is the total market, right? And total market is also moving target, because especially in the new tech side of it, there's a new market being created on the product we don't even know today. When you're launching a product, you may not even think about the market being created 2 years, 3 years from now, because somebody else had created a bigger wrap or bigger AI activities which you can benefit from. So we're looking at present to see, okay, where can this company go? There is no hard and fast number that they got to hit $1 billion mark in 3 years or 2 billion mark in 3 years. We don't look for that. We're looking at revenue projections and then whole market analysis and comparative analysis. Our analysts are all ex-Wall Street guys, so they know how to look through the companies. Bonnie, I do need to start trimming down because my other call is coming up.
Oh, okay.
So it's your time for another maybe 5 minutes. I could be late. I could be late 2 minutes. I don't think people will care.
Okay, does anybody have another question? Here's your chance.
I had one quick one. It's a different perspective, but you said you were a Wall Street person and had moved into kind of family office fund management. How did you initially make that move? Just curious.
Big mistake. Don't do it.
Why?
This is why. Big mistake. We learn our lessons through investing. It started with a fun story, and maybe I can take that little time and leave you some time more to talk about. Is one of our family member who basically said, hey, this company is coming up. You got to look at this entrepreneur. It's a great entrepreneur. He's building this great product. We should invest money in it. And I tell you, we got exited, and way before our company here in West Coast blew up. So we had capital. And that's the only source we had. We had no job at this point. So your capital you have to preserve, and you have to ask tons of questions. So we did. We asked this entrepreneur every question you can think of, and then we rolled the dice. So we put maybe each one of us, we were 5 member at that point. Currently we are 7, and we all put in some money, and we said, okay, let's see what this guy can do. And then 2 months go by, 3 months go by. It's like, where's the product? This is funding you from your pitch deck, right? So there's only the concept, product is delayed,
No.
and then other issues are coming up. Okay, let's surround him with some people we know, and we did. And then we just kept repeating the same mistake. Maybe he needs more money.
No.
And we did that with 27 of them. And that's what I say, don't. And we did that in the course of from 2009 to 2012. And then we learned our lesson to say, we got to go up on a food chain. And we started dabbling it off. I mean, the saving grace is still there. Maybe 2 companies are still coming through. And we didn't invest any money with them anymore. We invested, I would think, more than 3 rounds, and then we stopped. And but we have decent capital invested, and we'll see. Within maybe if those 2 companies, even the 1 company goes where we think they will go, there will be some saving grace. But so that's how we dabbled into. It's by mistake. It's no like we said, okay, we want to invest into this side. We want to become multifamily. It started like, okay, we got to invest, and then other. So we earlier, we didn't have this whole investment philosophy of consensus investment. We didn't have analysts. We were doing it all ourselves. What the hell we know about evaluating entrepreneurs and looking the risk and whatever? We all came from corporate America. We were all some kind of semi big shot or bigger shot in Wall Street or a buy side. And what the hell we know about talking to entrepreneurs? Yes, as I said, we love entrepreneurs. We love them to create something, but they need a lot of help. And money doesn't solve all the problems. We learn by mistakes. And of these 2, I think there's more than 2, but we really don't. We get their reports, quarterly reports as a shareholder. We are on their cap table still. We have never exited. Any investment we did in early stage, I mean, there are some companies, I don't know whatever happened to them, whether they filed or not. We just didn't pay attention, but we moved up. I mean, my philosophy is look through the next door and next positivity, then keep dragging yourself down on your negativity.
Thank you. Thank you.
Thank you.
That's an education.
So
Well, I don't know. I can only talk about my experience. You will all create your own experience. I mean, you can always learn from others' mistake and hope you don't make, but guess what? When you are entrepreneurs, you're taking risk, there will be mistakes, and the only question is how you learn from them.
True that. So I know you have another call coming up. Is there one more quick question, or
I'm done, dear. It's
Okay.
47 now.
all right, we're done. Thank you
Yeah.
so much, and thank you for showing up this time, Rich. I had to tease you. I'm sorry I had to do it. So
No,
thank-
this is other day I was my bad, and I said from the beginning, I usually don't make the same mistake twice.
and we
So
appreciate
thank you. This was a very encouraging, participating, and somewhat learning experience as well.
Yeah,
Thank
thank
you
you.
all.
Thank
Appreciate
you.
it.
Thank you.
Thank you, everybody.
Have a great day.
Bye-bye. You too.
Thank you so much.